Hi, my name is Nicholas Regina, and I'm the CEO and founder of Spark Financial Group.
Hi, my name is Michael Sakuro, and I'm the president and founder of Spark Financial Group. And welcome back to What Would It Cost? You bought a shed in Windsor?
You made money in the housing market last year? No way.
Anything you shot on, you would have made on.
What would it cost?
That's the $1 million question. You're looking at North Bay now is at $1 million. I don't even think they hand you the keys anymore. What is it going to cost?
How much? Hi, my name is Nicholas Regina.
My name is Michael Sakuro.
And you're listening to
What Would It Cost?
Is that good?
Today we're talking all things mortgage insurance.
With our special guest, Jean-Paul Pechente from Toronto Life Financial Group, top performer and a member of the $1 Million Roundtable. It's a pleasure to host you.
Pleasure's mine, guys. Thank you for having me.
Yeah, and we're excited to talk about it today because there's a big stigma between mortgage insurance, life insurance. Is it the same? Is it different?
Yeah.
Especially from a lot of our clients asking us and how we work together. So I'm really excited to do a deep dive on that. But before we get into that, explain to us more about this $1 Million Roundtable, given we know you're top of your performance amongst your colleagues.
Yeah, so the $1 Million Roundtable is a members-only club. You have to produce a certain amount of insurance services per year. And what that gives you access to is, ideas with the top performers from around the world. You share your ideas, you attend conferences 2 to 3 times a year. Yeah. And, you figure out how, your prospecting is, how you can generate more leads, how to provide better service to all your clients. So by being able to be a part of that, prestigious group, it's definitely an honor of mine as well, and I think it brings great value to our existing book of clients and our potential clients that will be eventually with us at Toronto Life Financial Group.
Absolutely. Yeah, no, that's awesome.
And what an accomplishment from being such a young man in the industry. And I know you started really, really young, especially for that niche industry for life insurance, right? And what you've been able to achieve in that short window, right? Yeah. And how you stay very humble and modest about your accomplishments.
I had the best teacher. I had a very good teacher.
Absolutely.
Giovanni.
Yeah.
Right on. Yeah.
Absolutely. So tell us a bit about Toronto Life. What you guys offer there?
So Toronto Life Financial Group has been around for over 30 years now, or 25, 1996.
Okay.
So, we have the top 25 insurance companies in all of Canada, and we do anywhere from life or mortgage insurance, whatever you want to consider it, critical illness, group benefits, disability insurance, and RESPs for the kids.
Awesome.
That's mainly what we specialize in.
I'll let you go into it first. So tell us the difference between mortgage insurance and life insurance and the big misconception.
And what it would cost.
So essentially, life insurance and mortgage insurance. So mortgage insurance, everybody, you get your mortgage, you check off that box when you're doing your application, or you go to the bank and the teller's trying to sell you on certain products. Yeah. But at the end of the day, a mortgage insurance is you are insuring the borrower. Okay, the person that's borrowing that money, you're insuring their lives. So if something happens to them, those funds are going to get paid out to the bank to cover their debts.
Right.
Yeah. Life insurance is the exact same thing. Just the difference is the bank is using the word mortgage insurance, and the traditional insurance company that we have are using the word life insurance. On the life side, the borrower, if they have debts, is still the insured person.
Right.
So the only difference now is why have a product with the bank or through a mortgage called mortgage insurance, which is creditor insurance. It is not a true life insurance product that protects the bank's debts, when you can have a life insurance policy that not only protects your debts with the bank or any debts you may have, but you're also protecting your family at the same time.
Right.
So if you have $1 million mortgage and you're able to have that money get paid out to your significant other or whoever that person may be, instead of paying the bank your $1 million, they may be able to use that $1 million, pay a little bit of the debt, put money towards the kids' education, buy another property if their mortgage is attainable. Yep. So in ways that you're going to allow that person to use those funds in a flexible manner, without having any funds at the end of the day. Because when something does happen to somebody, unfortunately, you want to make sure that these individuals have the money to maintain their same lifestyle,
absolutely.
Provide for their family. Yep. So many things that come into it. And unfortunately, through mortgage insurance or its creditor insurance, what they're doing is you're just protecting the bank's debt.
Right.
And with that, they are not true life insurance policies.
Right. And that was a big eye opener for me, especially when you had taught me about that. Because working at the bank for myself, we were always selling that. I wasn't too well educated, and I didn't know exactly what we were putting out there. And then having that conversation with yourself was a big eye opener. And like you said, it's that main point. You're protecting the bank's debt versus the client's debt, and I think that's a huge. It's a huge difference for when clients are choosing to what type of insurance they want. Because like you said, that mortgage might be attainable for them, but maybe there's other aspects of their life that aren't attainable. So I'd rather have that term policy that's carrying over the next 20 to 25 years that's going to be paid to me directly to either invest or pay off what I need to pay off versus this depreciating policy that is only going to cover a certain portion of my mortgage.
Yeah, absolutely. And on top of that, almost all the time, I won't say 100%, but 99% of the time, the products that we're going to be providing these clients, if it's apples to apples, we're going to be cheaper.
Yeah, so bring us through that in regards to what a typical bank policy would cost on $1 million purchase, and then what you could provide, and not only edge and beat that price out, but how your policy is loaded with a lot more upside for the client.
So with us, cheaper. Main thing. Secondly, we are going to be a level cost of insurance, meaning that when your mortgage is decreasing every year with your payments, so is that that creditor insurance or mortgage insurance. With us, you're paying $50, let's say, and it's $1 million the whole time your coverage. With the bank, your $50 starts at $1 million, and you're still paying $50, but it's going down and down and down and down. People don't notice that. Right?
And most times you can't carry it over to another lender. So if I want to refi next year and I want to go TD to Scotia, you can't carry it, whereas yours is just coverage to that person.
You can take it with you for life or for the term of the mortgage. On top of that, let's say you have a 10 or 20 year policy or 30 year, whatever it is. These are all renewable and convertible policies. The banks are not. Right? As soon as your mortgage is done, that insurance is gone. So that is not a true life insurance policy.
No,
that is called creditor insurance. And that is, again, to protect the bank's debts. And you should always protect your debts. But why not protect your debt with protecting your family and letting that money go to the individual that's making those decisions for your family? God forbid something should happen. Right? So, and keeping that policy level for the term. So that $1 million for that whole term, for that 20 years. At the end of the 20 years, if you no longer have any debts and you want to keep that policy, you can renew that policy. You can convert that policy to permanent. The choice is yours. So it's more flexible. It's 100 times better option. I mean, there's no comparison, right? And unfortunately, people are not given the education on this. And they don't know better. And sometimes people, you'll talk to people and they'll be out there like, I got my $1 million policy for $25 or whatever the cost may be. They turn age 50 or 60 and really they have nothing. They had a creditor product that is no longer, even if they want to keep it, they can't.
And I remember when you were explaining it to me, it's like a bulb went off in my head, and I just understood it and I got it. And it's one of those things, and it doesn't happen too often there. It's one of those things where you feel like standing on top of a building and saying to everyone, you're like, you need to know this, you know, like get in JP's office. He's going to tell you about how you're getting fucking ripped off over here in a nutshell, right? And to keep it professional, I feel that that's where an expert like you can come in and really be able to reallocate someone's funds in which they're paying into something that they don't even know what they're getting from it in comparison to what they can be getting from it. So it's helped our business when it comes to simply looking like the experts and having our ecosystem be something that everybody is feeling really good about when they leave our office and have, finished doing a transaction with us, because experts like yourself are able to come in and say, hey, did you know you're doing X, Y, and Z, and this is what you're getting, but for doing that same X, Y, and Z, this is what you can be getting. And it's just like, no, I had no clue about that. So you make us look really good because of, the strengthening up of the ecosystem that, you do for our business.
And I appreciate the trust. Full circle at the end, but and it's our job when somebody comes in our office and to the whole creditor and term and life insurance and all this. I mean, when an individual's in our office, we're going to explain to them term insurance. We're going to explain to them permanent insurance,
Right.
how that can go together, how you can pay off your policy if you're a young individual after 10 or 20 years, whatever that may be, and the benefits of critical illness and all the other things we do. And at the end of the day, you have to give the client the ability to make an educated decision.
Right.
So when they make that decision, and if that's to stay with a creditor product, to have just term insurance, to have permanent, to have term and permanent, to have whatever it is, at least you do your due diligence in spending, half hour and explaining to somebody what their opportunities are. Because a lot of times people don't know that. They're check marking boxes, I'm honest with you. They say, okay, well, I need to have this, or what is, they don't even know what they have.
Yeah.
Then a lot of times people are lazy to even call in because no, I have this, I have that. And if people want to take the time to educate themselves on what they have, it only takes 20, 30 minutes, and all advisors, all financial advisors, insurance advisors, wealth managers, should be taking the time to educate their clients on this stuff, or send them to an expert like myself or whoever it may be, to let somebody understand what they're purchasing. Because
That's
when
what the issue is the lack of the education.
That's right.
Just to go to your point on that.
That's right.
So bring us in. What would it cost? What are you paying for in regards to, bring us through a standard policy and what that's able to get you, and how that term appreciates, how the banks depreciates. Give us some real numbers.
Yeah, I mean, a real number is very difficult because it's always based on someone's gender, their age, smoker versus non-smoker. Do they have any health complications?
Right.
There's a whole, set of questions that have to be answered to get somebody a price. But if you want to just take $1 million for 20 years, costs you $100. Okay, a month. Let's just call it that.
Right.
Your average 35-year-old male. Okay.
Healthy
So
35-year-old male.
Healthy 35-year-old, $100 a month, probably cheaper. But simple term insurance, it's very simple. With us, for the next 20 years, that person is going to pay $100 and have $1 million of coverage every year.
Right.
Okay. On the creditor side, with the mortgage insurance, that policy is going to become every year $950, $900, or however that gets broken down based on their payments and their amortization
with the institution.
That's great.
Here's hence the depreciation.
You got it.
Okay.
Exactly. You got it.
So,
and as that goes lower and lower and lower and lower,
their $100 stays the same.
Their $100 stays the same. Good. And then on top of that, when that product is now finished, or your mortgage is now done, that product is gone. You have no insurance.
Exactly.
And funny too, as you get older, it's common sense there'd be a higher risk of you dying, right? So you're getting less and less coverage as that's happening.
Well, it's not only,
but it's also
the teeter-totter effect. It's never really in the
to my point
with the bank.
Absolutely. But to my point before now,
right.
If somebody does this product or has this product, and now they're at 40, a bulb turns on that turned on for you a year ago,
exactly.
Turned on for him at 40. He's like, well, I actually need insurance for when I am 60, 70, and they weren't educated to make this decision when they were 30, 35, 40 years old. It's going to be, not that I'm not saying it's not attainable, but it's very hard to pay for these premiums at a later age.
Okay,
and that's assuming you're in good health.
Talk to us about that. When you lock in at 35, that's your rate. That's your rate
for the term.
For the term. But say now you lock in at 40 and you miss that 5-year window, and now you've had a few health complications. You're not a well-oiled machine like you were when you're 35. What does that cost increase look like?
Well, the cost increase is going to be varied based on obviously your health conditions. Every year the premiums will go up based on that's based on mortality charts. That's how the insurance industry is basing their premiums. So every year you get older, the price gets higher. If you have health complications after, you may not even be insurable. Right. So, and if you can't get insurance, I've had many clients that have walked into my office that unfortunately they've had some sort of illness or they're diagnosed with something. And they're like, what can you do for me? And I would love to do everything for them, but you're uninsurable at that time. And there's nothing you can do. Once you have to buy insurance when you don't need it. Okay. We are giving you a piece of paper to deliver money to you in the future. That's what we're doing for you. Okay. So you're giving us money. We're giving you a piece of paper, which we will deliver the funds at a future date. But these are all products that you're buying when you're young. When you don't need it. Hopefully you're getting the education on these products to say, okay, yes, I need this. And a lot of young individuals today, more than ever, because my father's an immigrant, came here when he was 19 years old, he started off selling insurance. When they were selling insurance many moons ago, nobody believed in insurance because their parents didn't leave them insurance. That was another whole stigma on that. But today, it's a beautiful thing because a lot of young individuals, and I see it more and more every month, every year, that are saying, what's permanent insurance? I want to yield my policy or get a yield on my policy. How do I pay for my insurance by the time I'm 40 or 50 that it's done? And then they have these beautiful policies that are accumulating dividends on the cash value side, which is the monies they've put into it, and on the death benefit side. And that's creating another asset, like buying another house. It's completely different. But, when you're going to the banks and you want to go, comes the time where you're sitting down with your wealth manager or just a financial advisor, they're always going to be asking you the value of your life insurance. And on top of that, what is the total cash value in these policies? Right? Because these are all assets that you're creating for yourself.
Right. And part of any sophisticated investor's generational wealth portfolio, they always have this product.
Every individual I've dealt with, yes, absolutely. But if you want to talk individuals that have done well for themselves, if you want to talk about that respect for a second,
sophisticated investors.
Yeah, I mean, people don't forget, after your primary residence, after a couple things, you're gonna get taxed 33% on all your other assets, right? Whatever properties you have, potential businesses. And people, what they want to do is, you want to make sure that your kids are going to get all of these assets, all of these properties, whatever it may be, tax-free. And the way that they're doing this is they're buying permanent whole life policies. And when I say permanent, that means that these policies will have to be paid out upon death. Okay? So what these policies are built for sometimes now is for the sophisticated investor or sophisticated individual, is that they want to make sure that those capital gains costs are all covered. All those taxes, everything is all covered when they're no longer here. So those kids will take that lump sum money, because insurance is tax-free lump sum. They will take that tax-free lump sum money and pay off the government, because they're going to come knocking, asking for the money. You're going to pay them off, and all those beautiful assets that your parents built for you, or grandparents, or parents most likely built for you, you're going to be able to keep those. If not, to pay the taxes and the gains on all these properties, if you don't have the funds, it's very hard to keep these things.
Right.
So now talking, these savvy investors with larger portfolios. And of course, like you said, there should have that insurance for each type of asset, at least to protect them and to protect their family, given they're going to be taking over that asset. Now talk about these investors that have multiple properties, multiple rental properties, or whatever it may be. How's it work for the insurance? So I have $1 million house I just bought. I have $1 million policy. And now I'm a couple of years older. I bought a rental property. Should I get a separate policy, or how's it work? Do you add on to that policy?
Well, so there's two ways that you can kind of tackle that question. And the first one is, if it's just $1 million policy, you got $1 million mortgage. Now, when you buy that second property, your mortgage could have gone down to $600,000-$700,000, and you only have a $300,000 mortgage on the other property, and that $1 million can still cover your debt. Okay, that can still cover your current debt. Or a lot of times what happens is people are not going to just take out a mortgage based on their current debt. Sometimes they're going to have final expenses. They're planning for the future. That's what we do. So just because you have $1 million mortgage, sometimes a lot of people are going to come in, they're going to buy a $2 million policy or a $3 million policy, and that policy is going to be able to stay with them and carry whatever debts they accumulate as they're investing. If it is, to your question, where it's, let's say they just got that $1 million mortgage today, they got that $1 million property today, and tomorrow they bought another $1 million property. They would have to go out and cover that debt too by purchasing another policy on top of that. You can always add to your policies, but that would require new underwriting. It's a whole new process.
So it might be better off just getting a separate policy.
It's definitely going to be a separate policy, right? But again, sometimes people are just buying larger policies because they know what the future is going to have entailed to a degree. Whether it's buying real estate, that's why we do needs analysis. That's why we do personal needs analysis to figure out what someone's needs are and to make sure we're doing the proper analysis for them.
Absolutely. And then you were talking about, we're going mortgage insurance versus term insurance. You're talking about converting that to a permanent insurance. So explain a bit about a permanent insurance versus the term insurance you sell, and what a cost difference would look like for that.
It's my favorite.
Absolutely.
Permanent insurance is, you have a couple options, okay? You have policies where they're paid after 10 years, 20 years, or you can keep them for life.
Right.
And even the policies that you have that are paid for life, those are called T100s, where there's no cash values, or you can have them where there are cash values.
Right.
And let me make that maybe a little bit more clear. So mostly if you have a young individual like yourself that has, let's say, a 20-year policy for $500,000.
Yeah.
These are much more expensive policies than term insurance policies. But the difference is that these policies are paid for life after 20 years.
Yeah.
And on top of that now,
Yeah.
whatever you put in for that 20 years, okay, that money will be there at the end of that term, that 20 years. So let's say you dumped $250,000 into a policy after 20 years, you will have that $250,000 most likely, if the policy is done correctly, in cash value at the end.
Right.
And then what's going to happen is that $250,000 and that $500,000 death benefit that you have now will grow on their own based on the dividend scale. Right. And what better way to create assets than that? Because those are just going to grow and grow and grow. And that policy that was once $500,000 at, Mikey, how old are you?
24.
44, now at 64, who knows? Maybe it's worth 750. Maybe
Right.
it's worth 800, $1 million. And that's all
Large.
large. What would it cost?
Exactly. A lot. But no, I saw a lot of value in that when discussing just on a personal level. And I was looking at that. I came to you saying, I'm young, I want a future plan.
Yeah.
And it's I think it's a great product, definitely with the permanent life.
of you,
Absolutely, absolutely. Want to make sure and take care of those future kids.
We can definitely do another segment on permanent insurance.
Yeah, exactly.
I don't want to confuse the audience.
Season 2.
Yeah. Good. Yeah.
No, that's
right.
that's awesome. Thank you for coming out today and spreading that knowledge. I think, like I said, it's a niche market, but it's becoming more popular because, like you said, that stigma is away from. Again, we're a lot of second generation, third generation kids, and
That's
our
right.
parents or grandparents didn't have that. And I think it's definitely a really important product that people should be looking into and definitely looking at having for future planning. If you're looking at growing your portfolio investments and mortgages, invest in yourself as well.
Yeah, and just to end it off, I mean, as long as an individual takes the time to educate someone on these products, they have the capability to make that decision after.
Right.
Yeah.
Absolutely.
And just want to end it off by saying thank you very much for
my
taking
pleasure.
the time out of your busy day to come and spit your knowledge and your wisdom out on us and our listeners and our viewers. And it's been nothing but a pleasure knowing you, doing business with you. We started off as young men. Here we are today in a total other industry. And I tip my hat to what you've accomplished and all your successes. And I look forward to what the future holds.
Yeah, vice
between
versa.
Spark Financial Group and Toronto Life Financial Group.
Awesome, boys. Thank you.
Thank you. And thank you again for tuning in. We appreciate you checking us out and following along with us on our podcast journey. Be sure to check us out on all your favorite streaming platforms and check us out on YouTube. Be sure to like, share, follow, and we'll see you next week.
Next on What Would It Cost?
When COVID started, the market got weird. If you ask a real estate agent what's going to happen in the summer, they can't tell you. And if they do tell you, they're praying to God that they're right because they actually have no idea. I think that we're going through a major housing crisis. It's been messy.